Hi, I'm Jonathan Miller, and welcome to the What It Means podcast. For those that don't know me, I'm the co-founder and CEO of Miller Samuel Real Estate Appraisers and Consultants. We've been appraising residential property in the New York City metro area for about 40 years. And I'm also the author for 31 years of the Douglas Elliman Market Report series, with a lot of concentration in reporting in Florida, New York City Metro, and Southern California. But I keep tabs on different markets around the country as well. And then I teach market analysis at Columbia University for their master's program in real estate development. And I'm the author of Housing Notes, housingnotes.com. It's free, and I write posts on what's kind of going on in the housing economy, and I've been doing that for about 11 years. So I am a dull and boring numbers guy. But I this today I wanted to talk a little bit, since there's been a lot of uncertainty and negativity in the sort of housing universe. I wanted to talk about something maybe a little bit more upbeat, but it's in the housing economy, and that's luxury real estate, in terms of how it's faring, what the prognosis is for its performance over the next few years. Um, the word luxury is a dangerous word when it comes to housing and measuring the luxury segment. I've been writing these market studies for Elliman, as I said, for quite a while. And I didn't want to put an artificial threshold on what, above what price. So basically, I look at luxury in context to the market that it sits within. So um, I take the top 10%, meaning the 10% highest sales in a market, and I look at their performance in relationship to the overall market, or the market less the 10%. And so you can imagine a housing market like Long Island. You might have a top 10% starting at 800,000, and Manhattan you might have a top 10% start at 4 million, right? So it's relative to the entire market. That's the way, when I say the word luxury, that's what I'm thinking, just to give the proper context. One of the things I wanted to explore today is sort of how high-end real estate will do, barring any sort of strange or black swan events like COVID, something that was unforeseen, and just how it looks relative to um, the rest of the housing market. The rest of the housing market, we didn't have much of a spring bump in activity, which we normally expect. And I think that's largely because of the tariff tantrums, as I call them, this uncertainty that is sort of gripping consumers, that may ultimately bring us into a recession or an economic downturn. We don't know. The odds of a recession are still about 50-50. And just as a reminder, a recession really, in the context of housing, while it has the potential to bring rates down, it also creates a tremendous amount of job loss. And last time I checked, you need a job to buy a house, if you're getting any kind of financing. So in the discussion of luxury, I wanted to touch on about four things that seem to be working in favor or not against the higher end of the housing market, outperforming the balance of the market. There was actually, I wrote quite a bit about this on Monday, in yesterday, in at the time of this recording, in Housing Notes. The article or the post is called "Luxury Housing is Poised for Better Times Than the Rest." And um, what triggered my idea for this post was an article by McKinsey consultants that talked about luxury goods, not housing, but just the state of luxury. And for the last 5 years, the um, the performance of luxury brands has been a rocket ship. That we've seen a surge in uh, the the transaction volume, put it, of luxury goods, luxury brands. Actually, one of the key drivers of that was Asia, especially China. But now with the tariff tantrums or the trade war with China or that being in flux, um, that is somewhat in jeopardy, or that those brands are, very concerned about, the next few years. However, I don't think that has a tremendous influence on the direction of luxury real estate, high-end real estate. I think that the biggest driver of housing, um, or luxury housing, is the continued expanding wealth gap. Um, it's interesting. I post some charts, graphs on my post, but just in the last 20 years, let's see, 20 years, yeah, 20 years, 30 years actually, I should say, from 92 to 2022, the top 1% has seen a five-fold increase while in wealth, while the balance has largely been stagnant. And this speaks to you know across all housing markets, we've seen a tremendous skew towards higher end development, new development. Not that new development hasn't always been a little bit more expensive than existing product on the market, but the gap is really widening. And one of the smaller sort of examples of it was Billionaires Row, and there's lots of that market. That submarket is in Manhattan, but there's all kinds of, Miami has Billionaires Bunker, and Palm Beach has Billionaires Row. And what it is it's become a much bigger thing. It's not that luxury prices have escalated dramatically. It's that the product created for the high-end market has been, zooming upward. And in fact, about a decade ago, every so often I write about it. About a decade ago, um, I started tracking sales, existing sales, new sales that were 50 million or higher. 50 million is just arbitrary. And I was updating that. This is 2014-ish. I started tracking it. That's a long story why, but basically I started seeing these sales pop. Something that might have been selling for 5, 10 million was now on the market for 30, 40 million, 30 or 40 million. And I started tracking, and it seemed like I would update my master list like once every couple of weeks. Now it seems like I'm doing it every couple of days. And um, 50 million or higher is not the threshold for luxury, but that I'd almost call it super luxury, or whatever kind of adjective you want to throw in front of it. Um, but it really is becoming this market that is separate from the balance of the market. And the reason why I bring all this up is because luxury as an asset class in real estate is becoming, or it's the distance between that submarket and the remainder of the market is getting wider. And that kind of speaks to what the wealth gap represents, is that there's a spread between, the top 1%, or you could argue the top 0.01%, and everybody else. And I think that that's something that's going to be around for a while. So we have that being favorable to luxury. Also, too, uh, is that the dollar is noticeably has been noticeably weakening since the beginning of the year. Most of that has to do with the tariffs, the tariff tantrums, as I call it, where that is effectively weakening the dollar. The trade war that the U.S. is initiating against basically the entire world and all our allies is reducing the dependence on the dollar and threatens to make the yen or some other the Chinese currency, Japanese, anybody but the U.S. currency is the sort of default uh, trading currency. And the problem with that for the U.S. is that that makes uh, interest rates in the U.S. a little bit higher. And the tariffs and the trade war that we're seeing makes interest rates a little bit higher, and none of that is good for the housing market. And normally, when the dollar weakens, that becomes, think of it as a discount for international demand. Like, when the dollar is much cheaper than the euro, someone can use the euro to get more for their money in the US. And we've had periods where the euro there was like a 50% discount, and that's enough to pull people into the US to buy. They tend to buy higher end property. Um, uh, because of the uncertainty, and relating also to needed immigration reform, that I suspect we're going to see tourism weaken in the US, countries of origin. Maybe not, there won't be the same flow of people, which was also a good indicator of international demand. Um, I bring this up because I don't see this as being indefinite. The weaker dollar is probably, eventually, as the maybe the trade war chaos dies down a little bit, because other things will become more important to the current administration, and that's a big what if, that we could see an more inbound international demand to U.S. luxury real estate as a result. I just think it's going to be delayed, unlike it usually is, just because there's a lot of other issues in play um, at the moment. Um, I think and I brought this point, sort of the last point I talked about, the the exchange rate, or that the dollar weakening, the wealth gap widening. Luxury goods have been doing really well until this sort of trade war, sort of blew up in the last couple of months, which, by the way, with no strategy and a complete lack of understanding of what a tariff actually is. Let me just digress for a second, because this is all so dumb that we're going through this. Um, when you go to a grocery store and you buy $100 worth of groceries, you now have a trade deficit with the grocery store, because you bought something, $100 worth of goods, and the grocery store didn't buy $100 worth of whatever from you. That literally, it's an accounting mechanism. It doesn't mean that we're being ripped off at all. So I find it's just an unforced error by our government, that's going to damage our economy, and wealth. The goal is to bring in more manufacturing to the US, but that takes 20 years and a solid strategy. And I was speaking to a group of real estate agents last week out in the Hamptons, and I asked them how many times has uh, the trade policy or tariff policy been flip-flopped, because that brings uncertainty. No one can plan anything. And the guesses in the audience were like 4 to 9 changes or 4 to 7 changes. And it's actually more than 50. I have a list on my website. It's incredible. So if that uh, sort of chaos dies down, I think we're going to see an acceleration of international demand into luxury real estate transactions. Um, and the last point I'll make about luxury real estate is that in the current environment with the tariffs, the trade war, um, that has kept mortgage rates elevated and will keep them elevated unless it does enough to really damage the economy. I don't think the Fed is going to do anything, probably not even at any time in 2025 unless something unexpected happens. But prior to, April's sort of trade war announcement by the administration, we were seeing mortgage rates inch lower. Now, they're pretty much stuck at 7%, just below 7%. And I find it fascinating because Fannie Mae and Freddie Mac. Freddie Mac is where I quote the 30-year fixed rate from, and they publish it every Thursday. And it's fascinating because even they're hoping for more volume, mortgage volume. And they announced last week that rates fell. Well, they fell 0.02%, but you can just see how anxious they are to see lower rates. But anyway, the point I'm making is that elevated mortgage rates um, are less adversely impactful to the luxury market than the balance in the market. And the reason for that, it doesn't mean they don't impact the luxury market. They certainly do, but they impact it less. And the reason they impact it less is because consumers in the luxury market, especially as you skew higher in net worth, in the price point of the property, in wages or income, that they're less dependent on interest rates to make a purchase. And in fact, here's probably an easier way to explain it. If you look at a market like Manhattan, which is a high-priced housing market where between 50 and 60% of all the purchases are cash. So when you look at the purchases that are cash and you break it out by price, um, purchases that are 5 million or higher, which is like the top 8% of our housing market by price, um, uh, that's about somewhere between 80 and 90% of those purchases are cash. And as you move lower in price, the so for example, if you look at below $1 million in our market, $1 million is a big number in most markets, but in our market, it's about half of all the sales. Below $1 million, the amount of cash buyers is about 35%, somewhere in that range, about a third. So the idea here is all the price increments between below $1 million and above $5 million, they skew higher towards cash as you move higher in price. And that's the way to think of a cash buyer. The higher the price, the greater wherewithal that consumer has to have an alternative financing. And just to make the point is that someone that's buying a $5 or $10 million home isn't paying, if they get financing, probably isn't paying 7% as a mortgage rate. They're probably paying in the low fives, just because they have a relationship manager, somebody that works with them, a wealth manager that leverages or uses as collateral some of their other assets like the financial um, the financial markets, et cetera. And that brings up another point is that, uh, again, one of the reasons I think that there's, uh, the near term and midterm future of real estate is probably more favorable for the higher end is because, uh, consumers in the high end are, uh, they have more financing options, more alternative financing options than a straight up mortgage rate. And so just all that seems to be more favorable. So the wealth gap, the access to cheaper financing or the ability to pay cash, um, uh, and the fact that, I think eventually the discounting dollar is going to have an impact on bringing more international demand to higher end real estate, just because of the currency play, the ability to trade um, tangible assets uh, for tangible assets from intangible assets like the financial markets. I mean, I guess that's my broader point is that tangible assets, like a hard asset like real estate, is probably with the continuing volatility of intangible assets like the financial markets, that's probably favorable and probably to real estate and probably more favorable as you skew higher in price than lower in price. So it's interesting. I do hope you got something out of it, and I encourage you to check out Housing Notes at housingnotes.com. Monday's post talked about this in detail with charts and graphs. So hopefully you'll get something out of that. And if you have any questions, always feel free to email me at jmiller@millersamuel.com. I look forward I get great feedback from my readers of Housing Notes and listeners to the podcast. And feel free to share, situations that you're in or, comments that you have. It's always appreciated. Um, like I said, I appreciate you spending your valuable time with me. And one important takeaway of this discussion is to always remember that pie is better than cake.